Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading weekend day, October 27th, 2023. I'm President Brent. Thanks for tuning in. Well, this week's theme kind of goes along with where we are this time of year. It's Halloween, so I guess we can say trick or treat. Buy the dip or don't buy the dip. We got to see where we are with this whole mess. So why don't we just jump into this past week and then just kind of quickly summarize where I think the markets can be going. So far for our members, we're doing very well. We're in the high teens as far as percentage returns for the year. We're almost double that of the SPX, slightly under the NASDAQ, although I do believe NASDAQ may have a little bit further to fall. So let's just take a look at how we fared out this past week. If we look at it, all the indexes were in the red, solidly in the red, over 2%. In fact, year to date, we saw the Dow move back below into the red for the year, and the Russell is well ensconced in the red, 7% for the year. S&P is up 7.24% for the year. NASDAQ's up a healthy 20.80%. This is the second straight week where we've seen pretty much any rally attempt get swiftly batted down. Market sentiment, I think, is being dented by mixed corporate earnings so far, and concerns obviously about higher rates. In fact, the 10-year mortgage or Treasury note briefly breached 5% for the first time in like 16 years. Now, this past week, we did get a lot of focus on the mega cap, what everybody calls the Magnificent Seven, but let's just say the mega cap. We had Amazon, Google, Meta, and Microsoft all coming in this past week. Only Amazon or Microsoft actually did very well. Amazon this past week showed some strength as well, but the others really did not. Most of it around the interest expense, but higher expenses going forward because AI is going to take a lot more money and labor and talent to be able to really make AI a long-term success for any particular company. So we're going to see labor expense go up here. The other thing is that we're seeing the what do you call it? The cloud computing was kind of the undoing for Google big time, and for Meta and some of the others. So we're going to see how this thing shakes out. The other thing I wanted everybody to focus on, if you look at the PE ratio, you can see the forward PE ratio is now lower than the prior. So that means, as I said, when the PE was over 2021, I said it's way too high. In fact, I would like to see it back into the 17 area. But that, if you really look beneath the surface, you'll see that the PE ratio of about 493 stocks in the S&P 500 is like in the high 15s. It's just those top 7 stocks is what's keeping the PE of the entire S&P up as high as it is. Dividend yield for the S&P, you can see, is at 1.68. Treasury at a healthy 4.84%. And the earnings yield for the S&P is at 5.34%, which is still very healthy, and it gives you a real yield of about 164 basis points over the current rate of inflation. And then looking at the volatility, you can see it finished out the week at 21.27. Prior week or so, it was at 19.32. So it was up over 10% just for this week. So we're seeing inflation broach that 20 level. Now remember, this March, it got up to mid-20s. It actually hit up to 30 midday, but it pulled back and kind of settled around the mid-20s. Do I think we can get there? Yeah, if we broach a couple of points, which I'll show you in the charts, we'll get there. I don't see it going much more than that unless we have some known unknown event associated with a war. We know the war is going on right now with Gaza, with Israel and Hamas. That's the known part. The unknown is whether it expands beyond the territories of Israel out into a broader Middle Eastern type of conflict. If that happens, then we're going to see the indexes continue to move lower. So you need to factor that into your approach there. A couple of economic prints this past week too. We did see Q3 GDP come in at 4.9%. Of that number, if you dig into it, you'll see that over 55% of the GDP in Q3 was consumer spending. Huge numbers. Now, the estimate for Q4 is kind of an anomaly. We're seeing GDP estimated to come in at 1.5% for Q4. So this was kind of like just a real high speed kind of thing for Q3, but it's going to pull back. Meanwhile, we did get the PCE index. That's the personal consumption expenditures. That's, I think, the Fed's preferred inflation gauge. And it kind of gives us a mixed view. Inflation is moderating, but very, very slowly. In fact, on the monthly basis, PCE, which excludes food and energy cost, which I don't know why they exclude it, because what family doesn't live without food and energy? But anyway, they take it out, and it showed it increased 30 basis points in September from 10 basis points in August. But year over year, it ticked down to 3.7 from 3.8, so still stubbornly high. But it at least is going in the right direction. So we're looking at a Fed meeting coming up next Wednesday, but the markets don't expect a rate hike. The current rates right now in the U.S. are 5.25% to 5.5%, but the markets aren't looking for that this Fed meeting on November 1st. Now, if we swing over, and by the way, for the you could see the best and worst sectors for the week: utilities and energy, and then for the year, comm services and utilities bringing up the rear for the year. And then, of course, if we come over and take a look at the European markets, again, everybody in the red: the Euro stocks, FTSE, CAC 40, DAX, all the major indexes across Europe in the red. In fact, the FTSE's back in the red again for the year, down a little over 2%. The FTSE's kind of been following the Dow this year, really, but the FTSE's down, and then you can see the CAC 40 and DAX both in the green for the year, a little over 5%, but that's about it. Fairly weak. We did see, like we're going to get with the Feds, as I said, next Wednesday, but this past week the ECB left their deposit rate unchanged at 4%, right? And they said that they're going to maintain that level long enough to bring inflation down to their target of 2%, which is similar to the Fed's here in the U.S. And the ECB president, Christine Queen Bee Lagarde, as we like to call her, said at this press conference this past week that the Eurozone economy was weak and would remain so for the remainder of this year. So that's kind of my consensus there over in Europe. I would agree with that. In fact, if anybody moves into a recession first, official recession, some people say we're in one, but official recession to be Europe first. The composite PMI across Europe, which composite meaning it includes both manufacturing and services sector, fell more than expected to 46.5. Okay. This latest reading is a 35-month low for both services and manufacturing across Europe. And it's the 5th month in a row that the PMI has been less than 50. Anything below 50 is considered contraction for the economy. Anything above 50 is expansion. So that's why my belief is that Europe is much weaker than the U.S. And of course, if we look at Great Britain, which is not part of the ECB, their unemployment rate moved up a tick to about 4.2% from 4%. So that's kind of where I see Europe right now on the radar screen. And of course, if we look at Japan, you can see the Nikkei. They were also down this past week, but like the NASDAQ here in the U.S., up very healthy 18%, double digits. And the yield on the 10-year Japanese government bond, hit a 10-year high of 87 basis points. So I'm seeing the Japanese government trying to buy the bonds, right, which drives the bond price up and the interest rates down. But the other thing is we're seeing the yen crossing that 150 level. So I suspect the federal government or Japanese government is going to step in with the dollar as well. And the core inflation across Japan is at 2.7%. So they'd like to see, unlike the rest of the planet, they'd like to see inflation stay over 2.5% to 3% for over a year, because they've been below that forever, for decades. So they want to get that there. So we may see that. And the CPI in Japan rose to 3.3% from 2.8 in September. So, but one bit of bad news over in Japan is we did see the PMI fall to 49.9 from 52. So that shows contraction there too. So we're getting the manufacturing data worldwide showing contraction. So that is another reason why I think the global economy is going to continue to slow. And then of course, if we go to China, you can see it was in the red for the week and for the year. Hang Seng, which is Hong Kong, was in the green for the week, but solidly in the reds camp for the year. And a lot of analysts believe that China is starting to stabilize now after just being crushed for the past year. The first 9 months of this year, corporate profits in China fell by about 9%. But we're seeing Country Garden Holdings, that's one of the largest real estate companies on the planet. And it's China's largest property developer. They officially defaulted on offshore debt payments. I think it was a US dollar bond that they defaulted on. They can't make the interest rate payments. So that's going to be an interesting play to see how that moves itself out. Because just understand, in China, real estate is probably one of the biggest sources of wealth by most Chinese, unlike other countries where, like in the US, where it's the stock market. And yeah, your house does attribute to your wealth, but a lot of the higher income folks are making most of their money in the market. So we're going to see how that plays itself out in China. Because remember, China, their imports and exports are dropping dramatically, which also affects the exports of Europe and the US. So we'll see how all of it moves out. Now, what I want to do is shift the screen over. Let me just shift and show you a couple of charts here, and then I'll wrap it up this Saturday. If we look over here, you can see we're now in official correction territory in the S&P E-mini futures, okay? You can see the blue line when we closed on Friday, this past yesterday, we're down 10.75%. So that's an official correction. You can see both the 50 and the 200 EMAs have broached, or price action has broached both. You can see that huge downward vector on the red line, which is the 50 EMA, and the 200 EMA is starting to roll over too. And that started that at the beginning of this past week. MACDs, it's showing no signs of any divergences there at all. So that tells me that any rally right now is probably going to be sold, or the odds favor rallies being sold. You can see I have some support points underneath, all the way down to slightly above the closing price of 2022, right around 3,900. And you can see we broached the 23.6% fib node at 4174. And the next fib node at 38% would make us, or give us, the low of the year if we do get that far down. I don't think we will unless the war expands over in the Middle East, right? I think we're going to start to see some of the buying the dip come into play here, but all eyes are going to be on interest rates. And I'll talk about that in just 1 minute. Just to show you how ugly, if we look at the FANG index, which is, let me just put it up here. These are the big guys, doesn't include NVIDIA and Netflix. But if you look at the FANG index, it's still, holding up fairly well, very choppy. I mean, we come down, we hit highs here. It was up over 73% before it started pulling back, but well situated between the 50 and the 200 EMA, right? So, and if we look at the Magnificent Seven, that accounts for almost 80% of the profits of the S&P. And just as far as the index value goes, almost 29 to 30% of the index value of the S&P. And if we look at the equal weight as S&P, meaning there was no one stock greater than 1/500th of a percent of the index, you're going to see here just how ugly this looks. The equal weight, in fact, we made new lows. I left this on the screen, but we made new lows for the year. We're in the red solidly for the year, okay? This line here was where the equal weight was, where we closed last year. So everything is underwater. And if it wasn't for that AI jolt in the middle of the year with these Magnificent Seven, we would be having a very rare back-to-back SPX in the red. Now, we haven't finished the year yet. We are in the seasonality where we tend to get a bump through the end of the year, but we'll see how all of this plays out, okay? And then, of course, also bringing up the rear is the Russell. If we look at the Russell, it is clearly hitting, now is coming down to the 2022 lows. You can see I left that on the screen, but we've broken through the 23 low and now challenging the lows of last year in the Russell. And last year was ugly for everybody. So just not a very pretty scenario here. And of course, if we come over and look at the VIX, you can see here in the VIX where we move up into the 20 level zone here. So it's a little bit of a fear, but not quite, just a little bit. And I do believe if you go back to March, this was the last time we really had a big bump up, and the VIX was actually intraday, it was up in the mid 20s, 27, 28, before pulling back again. We could get up there if we have kind of a capitulation with a move lower. And then, of course, if we look at the all-important bond market and take a look at the 30-year bond, you can see here that it's just making new lows. It's come right down and hit my target, and that's where it is right now. Members, we'll go into some trade opportunities in bonds and interest rates Sunday evening, but it's come down and hit my target perfectly. All right. And again, if we look at 10-year interest rates, let me just find them on the screen here. You can see here on the 10-year rates, again, hitting my target perfectly. So my targets are working out very nicely in both interest rates and bonds. But if you hit the target bond, you're going to hit the target rate as well, which is just intraday. I got to move it up a little bit. But you can see here where we're sitting right now in these. So I do believe this is going to start to back off a little bit. So there's going to be some trade opportunities in the rate market here. Currency wise, well, the US dollar was just down basically on Friday. I do believe it can move up and get one final move higher, and then I'd be more interested to short the dollar and go long the euro. And of course, if we look at the euro, it's just been cratered this year. If you look at it, here's the euro. It's come down. We're actually in the red for the euro, near the lows, but not quite. But until we get back over the 50 and the 200, I'm not ready to go long the euro, but it's one of those trades that I think is going to set up quite nicely. And then, of course, if we look at gold, it's more of a hedge. It's over 2,000. You can see how gold has just moved right up, and it's going to probably challenge these levels here, and then it's going to get weak. If the war ends and we see money coming back out of some of these risk-off sectors, you'll see gold pull back a little bit. It hit my target here very nicely. In fact, it went just a little bit below my target before it started coming back up again. Okay. And then, of course, if we look at energy, which was another hedge I had mentioned to our members before the war started over in Israel, you could see here that we're kind of pulling back a little bit, but there's some great ways to trade that. But anyway, this was my target for oil, mid 90s, and then we hit it pretty much to the T right over here, and then we're just kind of pulling back a little bit, right? And then nat gas, it's been a great trade for us. You can see the nat gas, how it's just been following our channel right here. Just been a really good trade for our members, and I'll go through that for you guys this evening at our Sunday evening for our weekly market watch. All right, everybody, that's kind of where we're sitting right now. Everybody have a great weekend. Members, I'll see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and play with us because the water's warm and we're making money. All right, everybody, have a great weekend. Ciao now.